This panel is about what LPs need to know, and if you're still learning, thank you for staying with us. We decided that we would make this panel a little more lighthearted as we were talking about it. So we will be talking about a lot of things that you've heard of in bits and pieces, but not in great detail. We are going to touch on risk, including a study of the correlation between risk-taking in private equity and churches from Oliver. We are talking about some interesting topics that haven't come up as much coming out of co-investment, such as how to handle stock distributions. And we're going to talk a lot about the fun stuff from Josh's studies about succession issues and the cult of personality at the private equity firms. I think we'll start with Oliver talking about risk.
Thanks, Henny. So we were discussing leading up to the panel, and we thought about, okay, there's certainly a certain set of kind of characteristics in finance, that make some types fairly risk-taking, some fairly risk-averse. And we're discussing, how do you make sense of it, how to grasp this. And I was mentioning a study I'd done a couple of years ago, which is in my own little list of the kind of more esoteric original research topics, because a colleague of mine came up to me and says, well, he has this data set that tells you basically across the United States how many people on average go to church in a given county. I just don't care what church you go to, just the percentage of people who are part of a church community. And apparently, according to some kind of academic literature, going to church is an interesting proxy on the average for being risk-taking or risk-averse, because basically by being part of a religion, people are saying you kind of hedge your bets for the afterlife. So we were kind of chatting, how does this possibly have to do with anything that this room would care about? And we actually linked this to buyout activity and the riskiness of a buyout going bust under certain conditions. So we got a data set that just tells us basically where in the US companies were headquartered that underwent a buyout. We have data on where companies overall in the US were headquartered, and we went out and say, do we see any differences between the areas where lots of people go to church versus other areas in buyout activity? And as Josh always reminds us, the way to do it right, you basically control statistically for 100,000 other reasons of why a buyout may happen or not. And surprisingly, you find a very strong indicator that in those areas where people go to church a lot, you see much fewer buyouts. Now, if you believe that a buyout is inherently risky for a company, you will see this goes with this risk aversion thing. And our explanation is, if a buyout is risky and I, as the owner of the business, sell out, I don't want to go to church with the people that just got fired because my buyout went bust while I cashed out. So you're risk averse, you're avoiding the buyout. After this, we went further and says, well, those buyouts that happen in those areas, are they any different? And sure enough, they are different because they're significantly less likely to go bust. So that again goes with the risk aversion. If you still do a buyout in this risk-averse world, you want to be as sure as you can that it's going to be a successful deal. So, probably on the 7th page of a due diligence list of a GP, what to ask for before you touch a company, you should ask the CEO, how often have you been in church the last 12 months?
Thank you
That's
so much.
pretty good.
I was talking to Josh about VC in China, and I was talking about one of my favorite investors, Neil Shen of Sequoia, who runs their China business. And another VC said to me, he would have invested in the basketball player Yao Ming when he was 3, when none of us would have had the courage to do it until he was 15. I mean, it makes a lot of sense that VC is all about risk-taking because you have so little information and it's so early days. But Josh, what do you think about the GPs that say, if none of our deals go bust, we're not taking enough risk?
Right. Well, I think this gets at, the fun. A lot of in as much as we've talked about VC in the last couple of days, it's largely been conflated with private as a weird subspecies of private equity, which I think is in a way giving a little short shrift to venture, given how interesting a world it is today. But I think this is certainly one of the dimensions where it does differ, right? That in a way, when you think about the nature of returns in the venture space, clearly it's a game of we know we're going to lose money on at least on a risk-adjusted basis, on most of the stuff. And we really have two levers that we're pulling. One is we want to make sure that they're small craters rather than massive black holes when we lose the money. And the second thing we want to do is just make sure that we get enough shots on goal so we can get a, there's now a mixed sports metaphor, but enough shots on goal that we get a home run, a bunch of home runs, right? It's a very different kind of process than, again, you could say, well, growth equity has a little bit of the same features, right? Where, you can certainly have the Snapples and get the venture type returns from them. And you can say certainly there are characteristics of emerging market private equity where certainly, at least in some markets, what might seem as very blasé businesses in dull industries can still yield truly mind-boggling returns. But as you get to, down the spectrum to the plain vanilla developed nation private equity, it's not to say there isn't a skew and a tale of winners, right? But certainly the extent and population of those monster deals, at least in terms of multiples, is not really there to the same extent. And in that case, it does seem that the trade-offs in terms of loss, that the being able to be blasé in terms of dismissing losses becomes more problematic as a strategy. That the pain is so given that you don't have the saving grace of monster home runs, there's clearly necessity for more attention on the downside.
Precisely because tech has become so cool, you've always had some private equity firms that have done tech, General Atlantic, Silver Lake. Now a lot of firms are looking at it with envy again. Blackstone has made 10 fintech investments, but on their own balance sheet. Mm-hmm. Steve has no interest in investing in tech, it seems, because it's not a lot of money. But do you think that LPs should be concerned if they see their traditional private equity firms more and more segging into tech and earlier stage and growth equity?
It's a dangerous question. But I think that certainly one thing we can say with certainty is that you look back to this very fine vintage of 1999, and you saw a lot of crossover behavior, right? You saw buyout guys doing venture stuff. You saw hedge fund guys doing venture stuff. You saw, mutual funds doing venture stuff, right? It was just a sort of flood of players into the business, right? And by and large, it was not well timed, right? The classic example of this would be 3i, right, which announced in, whenever it was, June or July of 1999 that they were going to begin a venture capital initiative. And by the middle of 2001, when they finally put the brakes on it, they had somewhere close to 40% of their capital invested in venture deals. So, that's an extreme case, but, bad timing in terms of being too late to the party to do it. And I think in many instances, certainly when you look at least the experiences of the hedge funds and the mutual funds in the 1990s, it was bad investments, right? That they were sort of flocking to these later stage investments in the very largest and most publicized transactions. And by and large, it ended up being very ugly for them once the water started running out of the bathtub, right? That they were really left high and dry. So, I think it's natural to worry a little bit of saying, is this just sort of the deja vu all over again of people just crossing into the hot sector, which is, a very complicated and tricky game without necessarily the full skill set to really get it to really get it right. But, that's just extrapolating from the past.
Tim, you like the discipline of data in your approach, and this question may be hard to back up with any data. But when you see firms doing more growth investment, whether it's Uber or Airbnb in the case of TPG, for example, do you look at it and say, this is exactly why we love private equity, because it's flexible enough of a business model? Or do you look at it and say, this is strategic drift? How should LPs make that judgment?
I think it's not clear that we have that much data on it, but my personal view is that it's strategic drift. It's tempting to forget the fact that LPs can do diversification themselves, right? So if you want to do VC, you can do VC as an LP. If you signed up to a buyout fund, you thought you were getting buyout, you've probably signed up to some VC funds as well, and you think you're getting your VC through those managers. It's not clear that I, as an LP, would be happy if my buyout managers start thinking that it's rather sexy to do VC and far more interesting, and you get to hang out with some cool dudes in turtleneck shirts. But that's not what their job is, right? Their job was to buy the other assets. So for me, it's a no-no. And I think that will probably show up in some of the data ultimately, that people who do style drift, sort of suffer, I think.
Yeah, well, certainly there's enough evidence to suggest that people who radically change the size of their deals, sort of suffer in terms of suffer in general in terms of the performance. And there's also certainly some data that suggests that, diversification often is associated with, being less good in terms of doing it, which at least gives some confidence that, crossing over asset classes is at least got some, some risks associated with it.
I think one of the things, just a slightly different issue, but on the whole issue of risk, which is interesting, is that one of the big problems that we've all faced is not really having very granular information about what's going on within the fund at the deal level. And some of the research which has been coming out, some of the data that I've been starting to get at the deal level has shown that there are some interesting characteristics of GPs over time. One of which is that there seems to be a reduction in return and risk as GPs do more deals. Mm-hmm. So if you start looking at GPs who've done 200, 300 deals across their funds, the risk-return characteristics change. Mm-hmm. And they seem to be, not necessarily in a bad way. I want to be clear that the returns tend to go down, but the risk goes down as well. The risk of a bad deal goes down, the risk of a really monstrously good deal goes down. And that's, I think that's interesting because I get the impression that that's about the franchise value. You're really concerned about the franchise. You've got good systems and etc. They've got probably very good ways of doing investment appraisal and the like, and maybe they become a little bit more careful and conservative, and that's good for some LPs, I think. But I think that the risk-return characteristics do differ between, as it were, first-time funds and once you're on to Fund 10.
So it's not, I'm sorry, go on, Ollie.
It's a very interesting phenomenon, Tim, because having looked at quite a bit of these kind of D-level data and D-level evolution, I totally agree. I mean, you see the overall trend that the GPs get a bit more prudent and you want to say, yes, they want to protect the franchise. At the same time, it's very interesting to see how that kind of learning mechanism builds up, because you would assume that when you do a bunch of deals and they at least look to be successful deals, there's some mechanism going on, actually there are two mechanisms going on. You build some confidence that what you do and there actually is working out, and you're also building up, hopefully, some actual competence and learning on what's going on there. Now, one of the things I've been looking at in my recent research is that there's actually a big delay between you doing the deal and actually knowing whether this was a good idea or bad. And what's happening there in some cases, what the academic would call kind of a superstitious learning, right? You think you're invincible because you've done a bunch of these things. You're just good at doing this type of stuff. You don't necessarily always think about whether what you made you good, the experience, is really relevant to that other deal. Is having done a bunch of large deals qualify you to think and know whether doing a minority investment in Uber is a good idea or not? And what we see is that it's very important for private equity and very difficult for private equity firms to get the right learning going on. So how do you deal with bad news? How do you avoid falling in the trap of feeling invincible because you've done so many of those individual transactions. And so we actually see that in that kind of past pattern, it's very important for private equity firms to still listen to bad news and pay attention to bad news, and that the long run success of them is really a function of them building up the skill and the capability, and not basically flying an autopilot because I've done this so often that apparently it's doing well and I'm invincible.
Now, one of the important things is for information to get to the key people at the firm. And in some firms, there's this shoot the messenger mentality, and you can just see situations where the founders have not been aware until very late in the day. Josh, you were going to say something.
No, I think that we're going to get onto thin ice in a few minutes, so let's press on to the next topic, and may I'll say something outrageous in a few minutes.
You know, one of the things that had come up in some of the discussions on co-investment is this idea that LPs have GP envy, and it's so much fun to do co-investment. And, you know, as a corollary to that, one of the interesting situations I saw recently were some disputes between LPs and Silver Lake, because Silver Lake had a huge position in Alibaba. And a lot of the LPs said, please give us the stock and we'll manage that. Can you sort of talk about how LPs should think about those kinds of situations?
Right. So, I mean, I think in theory, the idea of stock distributions is very appealing, right? In the sense that you say, you know, LPs, you know, have different preferences and are coming from different places, right? If you're a family office, you may have a whole bunch of succession and tax issues to worry about, which as a pension fund, you don't necessarily have. You know, similarly, you know, people are going to have different stuff in their portfolios and different allocations, right? You know, you think about, you know, in an organization like CPP, which has a very structured way of allocating across industries, and clearly they might come at it from a different perspective than, you know, another institution where it's more, you know, bucketed by asset class and so forth. And you say, this is great, you know, essentially distributing, you know, giving the goodies to the LPs maximizes their choice. If they want to hold it, they don't have to incur the transaction costs of selling it and buying it once again. Unfortunately, there's a little bit of a wrinkle which makes this perhaps a little less attractive than it might be, which is that, you know, certainly stuff that we've done, and there's been some subsequent work by Mark Seasholes and others, which suggests that around the time of the distributions have a common characteristic. You know, they typically seem to happen at 5 o'clock on Friday afternoon at $10 a share. And the first trade at 9:30 on Monday morning is at, you know, 9, 8.5, right? Yet when the GPs go about the process of calculating their performance, somehow the number which gets used is the $10 a share in terms of the price, right? So in a way, that's already introducing some sort of distortion in terms of the you know, report card, in terms of how things are measured, and, you know, when you think about the waterfalls, it may even change who actually ends up with money, how much money in people's pockets when hurdles are reached, and so forth. Now, it's interesting that when we had finished this paper, we went and talked to one of the you know, large and highly respected institutional investors, not anyone represented in this room or at this conference, and, you know, presented these findings. And we were like, you know, this is really outrageous. You guys are getting, you know, to put it vulgarly, screwed over here by this sort of miscalculation in returns. And the response I got was like, Josh, how do you think our bonuses are being calculated? So there's clearly, in that case at least, a little complicity between the GP and LP side.
That's a great point. I think one of the most interesting elements in the discussions we've had here over the last few days, you know, and it came up in a question in your panel just now, is all LPs are not created equal, and there's a lot of conflicts between LPs. At the same time, you have a lot of LPs that have far fewer resources than others. To what extent is it a mistake for those LPs with limited resources to try and piggyback on what LPs with greater resources are doing and put their trust in them. Who wants to take that?
Yes, yes is the answer. It is a bad idea, right? Because I think
How's
that you know, you can pay for financial intermediation if you've got, you know, one person running private equity and hedge fund allocations. I don't think you should be doing co-investments, right? I mean, if you have, you know, as some of the large sovereign wealth funds have, hundreds of people working in your private equity department, then I start to believe that you have tooled up to the point where you can do that. So I think that, you know, if this is so in general terms, I think that's a very bad idea. I would never advise anybody that they should start doing that unless they have the skill sets associated with it, because it's a different set of skills. Doing due diligence on a fund is one thing, and picking your managers and making sure they've got the skills is one thing. Being able to pick the deals is a completely different thing. And if I was the board of trustees of the plan sponsor or the trust or the endowment or whatever, I would absolutely say this was not allowed.
I mean, in a way, it sort of gets back to a point which, you know, has sort of, you know, crept into the earlier discussion as well as into your talk yesterday, which is that certainly one of the historic features about private equity has been the sort of huge difference between the good guys and the not so good guys, right? The sort of huge dispersion of the performance. And then, you know, you suggested that's come down some, but certainly that's been one of the defining features of the territory. And
I think you all agree on
right,
that.
we all agree on that. I think that's
this.
one thing we can all agree on. And I think one of the problems you get into, right, we saw this with the, you know, with all the people in the 2000s who were trying to emulate the Yale model. I think we're seeing it today with the people who are emulating CPPIB, is that you can sort of copy the structure, but if you don't execute as well in terms of getting the, you know, either whether it's the right funds or the right direct deals, you can think something that looks exactly like Yale, but performs miserably, right? And in fact, we saw a lot of examples of people who seemed to be, you know, trying to emulate the endowment approach and having much less success at it, whether because of access or lack of skill in terms of being able to select managers and the like. They just couldn't really do it as well as Yale did, and because they were essentially ending up in the median rather than the 75th or the 80th percentiles, their performance was really miserable. And I think, as Tim is suggesting, I think there's a lot of that same drama playing itself out in the co-investment space. I think what's just is a little uglier there is it's not as clear that even for the really good guys, co-investments have been such a winning strategy to begin with.
And I can absolutely guarantee that the timing that you'll get the timing wrong. Everybody will rush into co-investment just at the wrong time, as valuations are peaking, as there's too much capital space, and as soon as something bad happens, everybody will quit when they should be going in. So that's my strongest prediction, that viewed over the cycle, over a 10-year cycle, I guarantee that the people who go into co-investment and then come out of co-investment will get the timing wrong.
So do you think that the sign that there's been almost no discussion of emerging market private equity here in this conference is an infallible indicator that now is the time to be plowing money into it?
Yeah, that's an interesting one, isn't it? Because I mean, I get the impression that, you know, there is a very big appetite for a lot of people to get into emerging market private equity. They're seeing the maturity of the emerged market private equity or developed market private equity as being sort of one reason for looking elsewhere. You know, where is the next inefficient market, as it were? But yeah, there hasn't been much discussion, has there? Loads on so much on co-investment, and we're perpetuating that. I think maybe you're right. This is a leading indicator of the fact this is the time to get out.
You know, there was a very interesting debate at the Harvard Private Equity Conference. Is it 2 or 3 years ago now, Josh? And Joe Barretto was there from Blackstone saying, we think the risk reward does not pay off in emerging markets. And David was saying,
last year,
we will soon be bigger. You know, I see the day very soon when Carlyle will have bigger portfolio of China deals than US deals, right?
So-
You know, for LPs, of course, especially those with inadequate resources, that's a whole nother challenge because so many of the players are local in markets like China.
Right. I mean, I think there's really I mean, since we're on this topic, why not run with it, right?
Yes.
I mean, I think there's sort of, I mean, in my eyes, there's sort of two issues here, right? One issue is that we know that historically, any way you torture the data, emerging market private equity has underperformed, you know, U.S. and to a lesser extent European private equity, right? That's, you know, a sort of defined piece in terms of numbers. And again, you can sort of take, you know, two views of that question, right? One view is, you know, we shouldn't be comparing, you know, emerging markets in the 2000s to U.S. in the 2000s, right? We should be comparing it to the U.S. in the 1960s when it was still a really immature market. And that, you know, just like it takes a while for LPs and GPs to get it right and figure out how the game is played, and that just as returns were pretty lousy in the U.S. in the first 3 decades and then ramped up over time in as much as the incomplete and imperfect data allow us to see it, we should expect the same kind of pattern to take place there. You know, I guess if you were, again, staying in the optimistic camp, you can say, well, it's also been the case that by and large, public equity returns in the emerging economies have been pretty lousy for the last decade. So the fact that private equity has, you know, outperformed the public markets, but but not been at the same absolute level. Again, you know, unless we believe there's some reason why, you know, some crazily inefficient public markets in emerging economies, eventually we might expect public market returns in emerging economies to come up and then private equity to rise with it. So I think that's one debate. I guess one philosophy, I guess there are going to be other people who say this is just a loser and that for some reason private equity doesn't really work there.
Let's take it one more nuanced step. And I could make the argument that private equity in emerging markets is a very different dynamic. For one thing, there's much less leverage that's available.
Right.
The equity component is much, much higher. And another, perhaps dirtier secret, is that very few of the private equity deals we see in Asia are actually, Asia, which I know best, but true for other emerging markets as well, is that very few of these deals are actually control deals, right? So are we maybe comparing two different things?
But it's not necessarily that different to how Europe was, you know, before the European Union, right? If you look at places like Africa, where there's you know, which is flavour of the month, I suppose, in terms of private equity allocation, you've got the same sort of structures. You've got, you know, lots of local players. You've got regional plays coming along. But a lot of the private equity that's going in there. Remember, we're seeing billion-dollar funds being raised for Africa now, and so these guys are not doing sort of two sort of crazy things. You know, they're sort of, you know, creating regional supermarket players. They're sorting out, you know, logistics companies. They're doing all the sorts of things that happened in Europe, as I remember. I'm sure it happened in the US, but I don't remember it. It was too long ago. But, you know, I think that some of these bigger funds are coming in there, and they're not doing stuff which is sort of like super, you know, sort of at the cutting edge, or where you need to, you know, there's lots of assets underneath them all. It's true they're not using much leverage yet. That's starting to come. China, again, I think that will happen. We don't see much leverage directly going into these deals, but they're not all, you know, sort of and much different in concept, I think, to the same things that were done when private equity first came into Europe.
Yeah. There's an interesting angle on this and the difference between, you know, private equity in emerging markets and emerging markets, which is related to the relative importance of the GP. I mean, looking at deal level data, we can basically tease out, you know, how important it actually is that a certain deal is done by one private equity firm versus another. And in the established markets, the answer is it is the absolute single most important thing. I mean, forget about getting the industry right or the country or the deal type. Got to be with the good GPs. That's the driver of returns. Replicating the same on a sample of individual deals in emerging markets private equity gives a slightly different angle. The GP does play a role there as well, but it's actually secondary to the deal type, the industry, being in the right country. So for the limited partners putting money in there, you really have to figure out that the area where you're playing emerging markets private equity is the good and the right one. And you cannot only rely on the fact that you're hopefully backing a good GP.
So what you're arguing is that if you're in a downdraft, like let's say Brazil is today,
Yep.
it's just going to be really tough making money even with the sort of most brilliant investment strategy.
Absolutely,
The
yeah.
macro
The
shocks
macro
have
dominates,
just
yeah.
been so large in some sense.
And the currency ones as
Right.
well, right? Because a lot of these returns have actually been pretty good in local currency. You stick
Right.
them into dollars, euros, or your favorite currency, and they look rubbish.
Rather.
Yeah, I think that's an extremely good point. I mean, KKR in India has a big business in extending rescue finance with equity warrants, and their performance was so good. But, you know, you had a 15% slide of the rupee against the dollar, and that took away virtually all the profits.
Yeah, or
And
stick,
it's
or stick in a
hell to try and hedge.
yeah,
the
stick in
rupee.
minus 50 relative to the Brazilian real, and you see why everybody's running for cover, right? So.
And so there is a whole added dimension of risk. We only have about 15 minutes. I wanted to come back to this whole question of LP resources. And I wondered if there's any data that shows the more resources LPs have, the better their performance. Because, you know, one of the big problems to me, especially with U.S. pension funds, public pension funds, is how under-resourced they are. And it is so sad to me that states don't make the political judgment that this is worth, you know, giving more compensation, giving more resources to, and that kind of data could be used to empower LPs.
Yeah, I used to think that until I heard that CalPERS had got Josh Lerner to go and speak at their conference, and I thought, my God, these guys have got
Pro bono.
I was going to say, how can they afford Josh? But then he told me he did it pro bono and didn't get on a plane, so that explained it. So I'm sure it is an issue, you know, they clearly couldn't
Right.
afford to pay you.
So, I mean, it is sort of sad, right, when you go to a pension, you say, well, you know, let's look at the Thomson Reuters data and benchmark this, and they say, what Thomson Reuters data? You know, and wait a second, you're like, wait a second, isn't that subscription just like $10,000 a year? How much of an increment of performance would you need to justify that $10,000? And usually the answer is 0.001% is all you need to make that. You know, I mean, it's insane, right?
Yeah.
It's just totally crazy, but you see it. But I guess there is an interesting question of how far this goes. I mean, Antoinette Shore and I did a paper, you know, a number of years ago on endowments, which where we had one analysis that we never actually, which ended up on the cutting room floor due to the case of the grouchy editor, but where we.
I know all about that.
Yeah, exactly. We all live that story in different forms. Where we looked across the endowments, so this is within the subset of endowments, and said, how much, you know, given the sort of a lot of the compensation data is revealed in the, you know, in the tax filings, the 990s and so forth that universities have to pay as nonprofits, how much of a link is there between the compensation being paid to the investment team and the ultimate performance of the endowment?
Yeah.
And what was surprising is that at least when you looked at the big boys, you know, sort of the $1 billion plus funds, just because once you get below $1 billion, it's just a very different game in terms of how constrained people are. We looked hard and could not find much of a relationship between how much people were being paid and all that. And I guess, you know,
It's kind of counterintuitive.
it is
isn't
counterintuitive, but in a way, you know, under the spirit of the anecdote being the plural of, data being the plural of anecdote. I mean, you just contrast the, you know, the experiences of our own endowment, which has had, you know, a quite aggressive policy, historically at least, of compensating people, but also had, it's fair to say, you know, a very, you know, just a bit of a revolving door phenomenon with that of, you know, some of the other endowments where they seem to have done a better job of, you know, sort of maintaining more stability. And it does suggest that, you know, to say that it's just money and just compensation is not enough, that there seems to, but when you look at many of the more successful ones that have been sticky, it seems that a lot of it has been about, you know, creating a sense of linkage to the university and a sense of a higher mission that is a sort of a non-tangible kind of benefit. So it's not just about having, you know, the top dollar to hire mercenaries to, you know, come in and do their thing for a short period of time.
Yeah, I agree with that, and I think that there's also an added issue, which is that I guess that with increasing sort of politicization of a lot of these questions, I guess it becomes there is a chance that it becomes a rather unpleasant place to be working in managing money. Look at.
Especially in public pension
I was
funds.
going to say, particularly in public pension funds, you look there's a lot of attention being focused on places like California at the moment. I don't have a strong, sense as to why that is, but it's become a very political thing, and it must mean that there's a lot of public glare being put on those guys who are having to justify the fact that they're doing their job and doing the asset allocation.
Right.
Now, so I think there can be some very positive things like, sitting in your office at the, like as Josh and I both have, we bring in people from our investment office and they get to mix with us. I mean, the non-pecuniary benefit is massive.
Right, because of course we're so much fun to hang out with.
Exactly. So, they get that, and then the public pension funds have to stand up in front of, a bunch of people hurling eggs at them. So I think it is
Clearly this is a tough issue, right? I think, I have nothing but the highest respect for Texas retirements, the teachers' retirements, Texas teachers. But I think that you can go and look at media accounts and the way that, Britt Harris, tried to put in a bonus system for people, and, newspapers were all over him saying, of all the bonuses being paid out by the state of Texas for their employees, this little branch of government with this Texas teachers retirement counts for whatever it was, 75% of the bonuses being paid. And it wasn't like he was trying to pay outrageous sums. He was just trying to,
But it's such a good investment,
right,
and
exactly.
the people of Texas are the
Right,
beneficiaries.
exactly. But the way it gets translated into the media is just the spin machine. There must be something wrong here that they're paying out all this bonus money and the other people. It's such a tricky set of issues, to be sure.
Yeah, with staying a little bit away from this tricky fee debate, it's just one fun commentary. I heard a discussion with someone at the conference who made a phenomenal suggestion, I guess, to all three of us to solve the kind of a public image issue of the California pension system paying out too much in carry. I'm pretty sure between the three of us we come out with some pretty good metrics to certainly identify a future bottom quartile private equity fund. We just advise these people to exclusively back those type of funds, and the carry payout will drop dramatically. I think they will be off the hook, and nobody will ever criticize them for the fee drag anymore.
I don't see many people taking notes on that point. I want to save a little bit of time for questions if you all have the energy, but before that, I just want to sort of talk about one last thing. I assume most of you were here for Josh's presentation of his paper, but in listening to you talk about the issue of carry and stability, it was very interesting. I got a call last year from somebody who was telling me, that the lockup for Blackstone shares will soon expire. You'll see a mass exodus from Blackstone. It hasn't happened, but the whole discussion reminds you that this still is a relatively young industry, and it's still very much, as you said to me, a cult of personality. And it's still far from institutionalized. As LP look at these firms, and many of them will in the next 5 years go through successions, most probably, right? How much attention should LPs pay to the kinds of issues you looked at? Should you look at the founders and say, they've made so much money, they're not going to be as motivated going forward? But, as you look at the firms, do you analyze track record of the firm? Do you look at the people? How should LPs think about the whole dynamic that you've touched on?
Well, it's a great question, and there's a reason why, sort of so much of diligence tends to focus on, performance, past performance, and performance measurement, in the sense that that's something that can be put in a spreadsheet and numbers can be really crunched, right? And in a way, when we did this earlier paper looking at the performance of different classes of limited partners, one of the things that was quite fascinating is when you tried to predict reinvestment decisions, particularly of fund of funds, we got a very high R-squared. We could do a great job of predicting which funds the fund of funds would reinvest with and which ones they wouldn't. and it was almost entirely driven by past performance, that it seemed to be very much of a reactive process. And again, you can just understand why they would do it. This is something that's tangible in terms of doing it. On the other hand, you looked at the endowments, your ability to predict whether they were going to re-up or not was much lower, because it was clear that while they used past performance, they were also using a bunch of soft information that wasn't easily captured. And
Blackstone did their own internal study of their LPs and discovered that likability and trust mattered more than past performance, something very subjective.
Yeah. And I think that in a way it's clear that historically endowments have done a better job of choosing who to re-up with. And it does underscore how important this sort of softer side of the analysis process is. I mean, I think we saw it in a number of the comments in the panel we just had, right, where people highlighted, the way in which even a high-performing group where there was a sense of some sort of breach of trust would often be enough to trigger their decision to walk away, despite the good numbers being presented. That, I mean, it's hard, but it's clearly really essential as part of being an effective LP.
But I think that the challenge for any founder of these funds, and I mean there's a lot of them coming up who are now sort of moving out and moving on, is that the long-term value of what you create as a business is a function of the processes, the culture, and the things which aren't sort of personified in you. It's not your investment decision that the LPs are ultimately going to invest in. It's the decision of the firm, and having the right processes and culture and the right economics and making sure the next generation are coming through are all parts of that process. And you see some people doing that very effectively, where you think. The markets know that at some stage Steve Schwarzman is going to move out, and the share price of Blackstone won't move, right? Because they already know that. It might be if it surprised you, it'll move. But the value of Blackstone isn't the stock market value of Blackstone isn't now particularly influenced by the value of Schwarzman, because we all know he's going to retire at some stage. He's created something of value. But that's associated with the sort of all the softer things that he's created. And some GPs don't manage to do that. That it's too much associated with cult of personality. And when the big guy or the big woman leaves, it falls apart.
I did a study with one of the LPs analyzing past data on a variety of these kind of qualitative things that they look at in fund due diligence, and they were trying to capture them in a way that you can then analyze statistically. You looked at the track record and the team stability and all these things. That played a surprisingly small role, and one variable stuck out that first surprised me. It was the assessment of the LP. How well does the GP handle data? How responsive are they sharing information? How good do they seem to have their shop in order? Which doesn't have a direct link to performance of the portfolio company. So we was brainstorming with these guys about it, and then the explanation we came up with, well, that's apparently a reflection on how data-savvy, structured, process-oriented they are as a firm, and they will likely impose this on their target companies. And you can only manage what you see. You can only steer the portfolio company if you have access to information there. So it turned out to be a very important factor and predictor of the sense of how well the GPs managed to then impose discipline and good management on the target companies. I think this was my favorite example from the past to see, yes, absolutely, you have to look beyond past performance and actually find really interesting, insightful elements of which group you should back.
We are almost out of time. Are there any questions before we break for lunch? Yes, thank you.
Triggering a lengthy discussion, so apologies. But when I hear about this research, the link between compensation of individuals and firm performance or fund performance, I'm always amazed how one-sided that seems to be, as if a financial incentive is the only thing that determines performance.
Right.
I wonder, have you in your research considered other factors such as firm reputation, inspiring leadership, team spirit?
Thank you.
Yeah, great question, right? And clearly the answer is, it's some of the story and certainly not all of it, right? I mean, we've talked a bit about Blackstone. You say, Henny alluded to the fact that this much heralded exodus or much anticipated exodus didn't occur. And if you say, why is that? A lot of it has to come down to the fact that, they've created a system where partners are clearly convinced that they're better off within Blackstone, even if it means they have to give up some of the goodies to the house, than they would be alone. That there's this gravitational pull that comes from the nature of the knowledge sharing, the company of really bright people and the like. So I totally agree that while compensation is one piece, and it seems as we saw in numbers that it matters, it clearly isn't the only piece. And in fact, we can probably argue that just compensation alone clearly isn't going to lead to a happy and stable private equity firm.
And on that note, let us have lunch. Thank you all very much.
Thank you, Henry.